Business quality and moat. Business model. Camp4 Therapeutics is a clinical-stage biotech company focused on regulatory RNAs RNAs that modulate gene expression. The proprietary RAP platform identifies regulatory RNAs tied to genes, then uses antisense oligonucleotides, ASOs, to increase expression of underactive genes. The initial pipeline targets rare genetic diseases such as urea cycle disorders and neurodevelopmental conditions like SINGAP1 deficiency. Competitive advantages / moat, potential moat, factor strength, weakness, risk scientific novelty. The RAP platform and RNA approach is differentiated with potential to treat a wide spectrum of haploinsufficient diseases. Early stage, unproven in large trials. Translational risk from lab to humans remains high. Pipeline leverage-led program CMPC-PS001 is in Phase 1. Additional preclinical assets show scalability if platform works. Years away from commercial revenue. Most biotech platforms fail before approval. Balance sheet debt is minimal, under $200,000, giving flexibility without heavy leverage. Low debt doesn't solve the problem of ongoing heavy cash burn and need for equity raises. Conclusion: potential exists for a moat if the science succeeds and scales. But as of now, the moat is speculative. Most strengths are still hypotheses awaiting proof. Management quality, leadership, credibility. CEO Josh Mandelbrim brings biotech experience from prior senior roles, including at Biogen. The company also has strong scientific leadership linked to MIT and the Whitehead Institute, which adds credibility. Capital allocation skill management has raised funding through multiple private rounds and IPO, channeling resources primarily into advancing the pipeline and platform R&D. No obvious signs of reckless spending, but long-term capital discipline can't yet be judged. Shareholder alignment, no dividends, which is typical for a biotech at this stage. Share dilution is an ongoing risk because more funding rounds will be required to support trials and operations. Financial strength: revenue, practically no commercial revenue. Around $3 million trailing 12 months, mostly from collaboration or grant income. Profit margins, negative. Operating losses dominate due to high R&D expenses. ROIC, negative, reflecting losses and no returns on capital yet. Debt levels, very low. Debt is negligible compared to total assets. Free cash flow, strongly negative. The company burns cash each quarter. Conclusion: by Buffett standards, financial strength is poor. Consistent losses and dependence on external funding. The only bright spot is low debt. Intrinsic value valuation here is speculative, since no profits exist. Any intrinsic value calculation relies entirely on assumptions of successful drug approvals. Optimistic scenario: if their lead asset gains approval and commercial sales begin in 5 to 7 years, revenue could potentially reach hundreds of millions annually, justifying a higher valuation. Bear scenario: if trials fail or are delayed, cash burn continues, dilution increases, and intrinsic value falls below current levels. Current market valuation appears modest, but the margin of safety is thin unless one has strong conviction in their clinical success. Long-term prospects, industry outlook, gene regulation, and RNA-based therapeutics are a promising frontier in biotech. Demand for treatments for rare genetic diseases is strong, and regulators are supportive of orphan drug development. Risks: clinical failure, safety, efficacy, delivery challenges, regulatory hurdles, and long approval timelines. Constant need for capital leading to shareholder dilution. Competition from other RNA-based biotech firms. 10-year potential if Camp4's platform proves successful, could expand across multiple indications and generate durable value. But probability of success is uncertain, and most early-stage biotechs don't reach commercial maturity. Final verdict: Buffett-style fit criterion meets. Understandable business partially. Gene regulation is conceptually simple, but technically complex. Consistent earnings, no losses dominate. Good ROIC no, negative. Low debt, yes. Attractive valuation only speculative, dependent on clinical success. Long-term moat possible, but unproven. Bottom line: Camp4 is not a Buffett-style investment today. It lacks the predictable earnings, strong returns on capital, and proven moat Buffett demands. At best, it's a higher-risk speculative biotech play with transformative potential. Human hook. Camp4 Therapeutics wants to flip the script on genetic disease, turning the volume up on good genes instead of just silencing the bad ones. It's bold, it's innovative, but is it Buffett-worthy? Let us break down whether this biotech is a hidden gem or just another cash-burning science experiment.